Welcome back to the conference. I hope you had a good lunch. Didn't get too cold. It's the cold corner in the building. And we have a wonderful speaker to warm you up. Jeremy Stein doesn't really need much of an introduction, but that's what I was asked to do that anyway. So Jeremy is the Moise Safra professor in economics at Harvard. And he has also been at the Federal Reserve as a governor and served as senior advisor at the Treasury, the secretary, and if I get it right, was also before that on the staff of National Economic Council. So that's basically where we're next to the White House. And I remember that very well because we had very interesting conversations during the crisis about what to do with failing banks and whether they need to be restructured and the like. And that was wonderful, and I have very fond memories of those conversations, Jeremy. But I got to know Jeremy really from the literature because we have a little age difference, and I have to study all those beautiful papers that are crystal clear the way they're written, but also it's really impressive because it's increasingly rare in academia to be broad and to span more than one field, and Jeremy spans at least 3 fields. So you have basically financial intermediation, monetary policy transmission, and market functioning. And the beauty of that is this spans exactly the 3 organizing business areas here, so it's of interest to everyone. And I think beyond that, what increasingly is very clear in your work is that you are bridging from academia to policy. I mean, of course, having been also on the other side. And I think that's, to most of us here today, you're known for that, in particular, the interaction between market structure, central bank balance sheet design, etc. So it's really how to bring models, also to combine them with practical policy insights. And then all the public service you've done, editing the leading journals and the associations we all care about and all that. It's too much to name. So we have a very interesting paper by Jeremy with some very long-standing co-author and some more recent ones on the Treasury market dysfunction and what are possible implications for the central bank. It's very much written from a US lens, but you are allowed to ask questions from a Euro area perspective. I encourage you to do so. But before we open for questions, the floor is Jeremy's for 40 minutes or so, and I get out here. Thank you.
Thank you, Luke. Thanks very much. I especially appreciate the reference to my age. Yes, really. Yeah, so this is a joint project with Anil Kashyap, Jonathan Wallen, and Josh Younger. Just to give you some motivation you probably don't need at this point in the conference, we started out thinking about, and again, this is sort of US-centric, we started out thinking about events in the Treasury market in March 2020. Just a really, really quick recap. There was a ton of selling. Roughly, you can think of that as coming about 1/3 from hedge funds, about 1/3 from bond mutual funds, and 1/3 from foreign official accounts, foreign central banks, okay? And that amount of selling, each of those were sort of on the order of $200 or $300 billion. So cumulatively, that sort of overwhelmed the dealer community, which manifested in a bunch of different ways. Liquidity, trading liquidity in the bonds, in the Treasury bonds was badly impaired, especially in the off-the-run issues. The ability of the dealers to intermediate repo, i.e. the spread between the rate at which they borrow in the repo market and the rate at which they lend widened, and a bunch of other things. So the Fed stepped in. They did various things. They started out trying to repo lend. They at some point excluded treasuries and reserves from the leverage ratio. None of that was sufficient, so they come in and they buy just an enormous quantity of bonds. And just to remind you of the scale, there was a 10-day period where they bought almost $700 billion of bonds. That's $70 billion a day. We thought we were doing something pretty big with QE3. That was $85 billion a month. So this was just enormous, ends up being about 1.6 trillion by the end of May. And one of the things I sort of want to draw your attention to is the tension that this, so on the one hand, I think as a pure market function thing, this was overwhelming force and it was successful in restoring market function. Question I want to kind of have you guys thinking about is, were there any costs? And one cost I want to kind of highlight, unlike I think the Bank of England later on with the LDI episode, they did not do a great job of drawing a distinction between market function and monetary policy. And in fact, if you read the various statements, the first one, I guess in March or whenever the first thing was market function. And later on, it starts talking about market function and the effective transmission of monetary policy. And it all starts to kind of bleed in that direction. And I think not coincidentally, they end up just doing an enormous amount of bond buying. I think the whole episode from start to finish ends up being something like $4 trillion. And you can ask yourself whether this is costly. Ex ante, it's sort of treading to some extent on the role of the finance ministry by overriding their debt maturity decisions. Ex post, this ended up being very costly because there was inflation and rates went up, so the Fed ends up losing a lot of money on this position, which it's a real cost to taxpayers, much as if the Treasury had decided to dramatically shorten their debt maturity. And then there's this confusion with monetary policy. And just to make that feel a little bit more salient, imagine this happened again. And now we're in a world where inflation is running above target. You don't want to come in and buy a ton of bonds and have people think that you're easing monetary policy. So that's kind of the problem that I want to have you focus on. Anyway, so what do we do in the paper? We're going to try and talk about I'm going to try and talk about three things. One is just to understand kind of how the interplay of various actors in the market creates some fragility. I'm just going to sort of tell you a story of sort of the genesis of the fragility. I'll show you some data which kind of is consistent, and then ask, if this is the story, and if you believe the story I'm telling you, what does it say about how the Fed might do this differently next time? Okay, that's kind of what I want to get to, is sort of a policy thing, but I want to get there by kind of telling you a particular story about where market function comes from. All right, so depending on time, I may do an equation or two, but I think I can kind of do the story in words. So there's basically three players in this thing. What I'm going to call the asset managers. By this, think of this as some mush of pension funds, insurance companies, and bond mutual funds. Okay? Then they're going to be relative value hedge funds, and then there'll be the primary dealers. Okay? So the people that I'm calling the asset managers, they're going to be the only ones in this model who actually are long duration. That is to say, long interest rate risk. But the key assumption that I'm going to make, or that we're making about them, it's empirically accurate, is they like to take some of this duration risk by holding the physical treasuries, but they like to take some via the derivatives. Okay? And what's the story for that? One way to think of it concretely as a pension fund or a life insurance company. On the one hand, they have long duration liabilities, right? So just sort of matching duration would suggest they'd want to have long duration assets. Okay? So one way they could do that right away is just buy a bunch of 10 or 20-year treasury bonds and be done. Okay, but you might want a little bit of extra interest or extra yield. So a way to get some yield is, in addition to having the duration, is to take some credit exposure. Okay, so at some level, the ideal security for them might be like a 10-year corporate bond, right? Because then they'd have the right duration and they get some extra compensation for the credit risk. Problem is, there just aren't that many long-term corporate bonds in nature. Certainly not nearly as many as sort of the demand coming from this very, very, very big sector. So what's one way to do this is you synthesize for yourself a long duration corporate bond by holding shorter maturity credit physically and some derivatives on top to lengthen your maturity. Okay? So that's kind of the primitive friction that drives everything. Okay? These guys have a demand to hold some extra duration in derivative form. Okay, then I'm going to be a little mushy about whether the model is too simple. I'm going to be a little mushy about whether it's futures or swaps. I think empirically, bond funds tend to be more futures. These other guys tend to be more swaps. I'm going to kind of blur that distinction. Okay? But think what that does. There's sort of this demand for, I'm going to call it the futures, but there's this demand for futures that's going to push up the price of the futures relative to the physical treasuries. Okay? So you've got this sort of incipient pressure on that spread. Okay, in is going to come then the relative value hedge funds, right? They're going to take the other side. In so doing, the economic service that they're providing is basically warehousing. In other words, the asset managers didn't have enough balance sheet to do this all on balance sheet, so they're going to end up renting some balance sheet from the hedge funds who are going to have to be compensated in equilibrium for doing that. Okay, so the hedge funds are going to be short the futures that the asset managers want to be long, but then they're going to hedge by holding the physical treasuries. That's they're doing the warehousing of the physical treasuries. Okay, in equilibrium, you'll see the spread is pretty small. The spread is pretty small. You know, think something like 5-10 basis points wouldn't be all that interesting, but for the fact that you can lever this thing very dramatically, right? You can get a lot of repo against treasuries, and so, you know, if you can lever it 99 to 1, then the 5-10 basis points becomes sort of interesting. Okay, so that's going to be the hedge funds, and that's sort of the story there. And of course, you can see that's going to build in some fragility if the way you make this work is with 99% leverage. And then the last set of players are going to be the broker-dealers. And you can think of them in normal times as basically doing two things. One is just market making, buying and selling treasuries. The other is intermediating the repo market, borrowing from borrowing in the tri-party market, say from money market funds and lending on to hedge funds. And then they're doing a little bit of this basis trade. I'll show you the data, but you know, roughly in normal times, 90% of it is being done by the hedge funds, and the sort of secondary bit of it is being done by the dealers. But of course, then what can happen? That's what I had here. You know, normal times the dealers, they've got their capacity. They're allocating it primarily to sort of dealer stuff. Okay, as the Treasury market is growing, the asset managers are demanding more of the derivatives. That's leading the hedge fund position to get bigger and bigger. And then there's some fragility. In March 2020. I think one way to tell the story is that as volatility in the bond market went up, the futures exchanges started asking for more margin. And again, if you're levered 99 to 1, if they ask just for 1 or 2 or 3% more margin, that's very large in a relative sense. That forces the hedge funds to delever. So they're now selling this stuff. Who in the short run steps in? It's the dealers. Okay, but now the dealers have a sort of certain amount of balance sheet capacity. If they're going to start doing more to absorb this, they're not going to have as much capacity to do the other stuff. And when they're balance sheet constrained, sort of the most simple first order condition is going to say if the basis spread spikes, other things are going to have to spike too, because they're going to have to be sort of equating things on the margin. Okay, so under stress, you're going to get not only the basis widening, maybe you don't care deeply personally about the basis in its own right, but that spike in the basis is going to be very correlated with liquidity in the Treasury market drying up, with repo intermediation spreads, because again, the dealers are kind of on the margin of all of these. Okay, so that's going to be kind of my story of how you get fragility. Okay, what's a policy kind of thing? And again, let me be careful. I don't want to argue that a frontline policy response should be Fed bond buying, okay? And in fact, you can be agnostic roughly as to how good or bad you feel about that. You might say there's a lot of moral hazard. I want to make a much more qualified argument, which is suppose the Fed finds itself in a position where its judgment is this is pretty bad and we need to buy bonds. So conditional on buying bonds, I would say, why do you need to buy them outright? Okay, you can think about this two ways. One way is, what are the hedge funds liquidating? What is the nature of the fire sale? They're not just they were fully hedged, right? They're doing a relative value trade. Okay, so what are they unwinding? They're unwinding a package that is long the Treasury and short the future. Okay, so what does it mean to absorb the other side of the fire sale? You can absorb that same thing, which would mean buy the Treasury and sell the derivative. Okay, that's one way to think about it. a little bit stronger, I think, is even if the selling hadn't come from hedge funds, okay? Suppose the selling, as it did in 2020, came in large part, sort of was naked selling by, say, foreign central banks. There's a core fact here, which you may or may not know. I didn't know. This is Jonathan Wallen's fact. The dealers are always duration neutral. You think of them getting kind of bombarded by all this selling. They are getting bombarded by selling of physical treasuries, but they always hedge it. Okay? So their problem, the problem the dealers had in March 2020, was not that they were overloaded with duration. Their balance sheets were stretched because they were absolutely taking a much bigger position in cash treasuries, offset by a bigger position in derivatives. Okay, that, for a variety of reasons, leverage ratio, basis risk, whatever, that does stretch your capacity, but not because you're eating too much duration. So the Fed, if the Fed's goal is to sort of unclog the dealers or take stress off the dealer balance sheets, it can do that without taking a naked duration position. It can do that by buying the physical and hedging. Okay, that's the core of our argument. And then it's not that that's problem-free or moral hazard-free. I'm going to try to convince you that that may be better in a relative sense than doing the just naked buying duration. You can't confuse it with monetary policy anymore. It's not designed to lean against the term premium because you're not taking, our standard theory of QE is you take interest rate risk out of the market. Here you're not doing that. Okay? It doesn't expose you to losses because, again, you're not taking interest rate risk out of the market. So it's a sort of qualified argument to say if you were going to go do bond buying for market function, one way of making it very clear that it's market function and non-monetary policy is you can do it on a hedge basis. And at least if you believe our diagnosis of the problem, that should basically have the same positive effect on market function as doing it unhedged. Okay? So that's the basic argument. All right, I'll do a couple of equations. So this is a very, very simple model. It's just got one period. So I'm going to define, there's going to just be one period zero coupon treasury. I'm going to call its price, anyway, PT is the price of the treasury, PF is the price of the future. It's just a one period model. So if there was sort of perfect arbitrage, the price of the future would be the price of the treasury times 1 plus the short rate. Okay, we're going to imagine situations where there's a violation of this parity thing, and I'm going to call X the basis. And the sign convention is that a positive X means that the future is expensive relative to the cash treasury, so the indicated arbitrage is going to be to sell the future and buy the cash. Okay, so that's the basis. As I said, I'm going to have three sorts of players here. The first set are the broker-dealers. I'm going to assume, and I'll show you some kind of remarkable data, that they're hedged, that they just don't take outright, they take basis risk, but they don't take outright interest rate risk. So I'm just going to assume, it does, okay, oh yeah. So I'm just going to assume that their long position in cash treasuries is exactly equal to their short position in futures. Okay, and I'm going to say again, as I said, to start, I'm going to make it very simple. They just do market making and a little bit of this basis trade, and they have some balance sheet, total amount of balance sheet space that they can allocate among the two. Okay, skip a little bit. The basic obvious thing is there is going to be, if the balance sheet is in a constrained situation, right? So if their balance sheet's scarce, the basis spread X is going to be proportional to the market making spread. Okay, in other words, you're going to kind of allocate capital efficiently. So if one goes up, you're going to draw capital away to the point that these things up to a sort of constant of proportionality are going to be equal. So first empirical prediction is under stress, there's going to be correlation between market making and basis spread. Okay, and how much will the dealers want to buy treasuries? Well, it'll have to do with their total capacity. They'll do more when the basis spread is bigger, and they'll do less when market making opportunities are good. Okay. Hedge funds are sort of similar. I'm going to make these guys just basically do, these are not all hedge funds, these are sort of the relative value hedge funds that trade the basis. Key assumption here is that they do that with very little equity. Okay, so 1 minus Gamma is the amount of repo that they use. So these are their returns. They also have some other activity that they can do, just to kind of give them a bit of a trade-off. And so, how much are they going to do? Again, they're going to be fully hedged. They're going to do an amount that has to do with their total capacity, again, the basis, and some measure of their other opportunities. But again, we're getting some gamma squareds here, which is telling you just that this leverage is really important. When gamma goes to 0, their positions are going to get very big. Okay, that's kind of the key point. They're going to be super sensitive, even a small basis. What this is saying is even a small basis can drive enormous demand if you can lever. Okay, it's kind of intuitive. All right. And then finally, the asset managers, they're the only ones who actually take interest rate risk in this model. Okay, as I said, I'm going to assume that they do it by doing both cash and Treasury, some mix. I'm going to make a very crude assumption that they just decide they always want a fraction of their exposure via the derivative. Okay, that's very crude. I think a better sort of fuller model would have this theta depend on stuff. Like if credit spreads were big, they really, really want to have more credit in their portfolio, then they need to do more derivatives. If credit spreads were to collapse, they would be like, I can do this all on balance sheet. Okay, but just as a sort of very simplifying thing, they're going to have this sort of inelastic kind of cash futures trade-off. Okay, and again, the broad motivation here is this enormous kind of industry, but there's just not that many corporate bonds of long maturity. So if the ideal thing for you is a long maturity corporate bond, this is one way to get it. Actually, another little piece of intuition is think about, and maybe this is most mechanically like the model, think about an open-end bond fund. Okay, so, and imagine it's trying to match a benchmark. As the Treasury issues more debt, because Treasury debt tends to be longer maturity, right? That's going to just mechanically push out the maturity of the duration of the benchmark. And then they're going to want to basically keep up with that. And derivatives is one way of doing that while not abandoning having some credit exposure. Okay, so that's a pretty mechanical sense in which they're going to want to do some, and in which their demand for the derivatives will be kind of yoked to total Treasury supply, which we're kind of doing here. Okay, and so these guys, we are having them take duration risk, and then this is just, you can think of this as just a simple mean variance kind of trade-off. This is now their total duration exposure. I'm just going to assume it's proportional to the term premium. And the only trick here is I'm expressing the term premium as a weighted, the long side of the term premium is a weighted average of the return you get by doing it synthetically and the return you get it in cash, because that's kind of how they're doing it. But this is effectively in our model, this is the term premium, and A is like some measure of their risk tolerance. Okay, so that's that. Okay, and then it's pretty, you don't need to look at all the math. There's basically two markets we have to clear. We have to have the total demand for treasuries equal the total supply, and we have to have net zero demand for the futures. Okay, so I'm going to clear the cash treasury market, clear the futures treasury market, and then this decouples exactly as you think it should, which is since the asset managers are the only ones who are long duration, right? The term premium is going to be completely determined, this is number 9 up here, is completely determined by the supply of treasuries relative to their risk tolerance, right? They're the only ones who are eating the duration. And the basis, the only guys who are playing the basis are the hedge funds and to a lesser degree the dealers. And so the basis is going to be tied down basically by their behavior. Okay, it just decouples. Okay, and you can see, by the way, the basis mechanically increases so this is the first kind of important implication. Treasury supply goes up, the basis goes up. Why? Because the asset causes the asset managers to demand more futures. That basically puts pressure on the basis. That also then draws in more hedge funds. So you'll see that the hedge funds' positions goes up as well when the Treasury market gets bigger. Okay. And then you can ask what happens if we put this market under stress. I've done the simplest possible experiment here. I've just said, suppose for whatever reason, the hedge funds blow up. Could be because of margin calls. It could be because some of their other trades have gone bad and they've been forced to. Suppose they basically just step out of arbing this thing. Okay? So before, obviously, their risk tolerance and their capacity was very important. If you take them out, all that's left are just the dealers. And so now it's only the dealers' capacity that's going to set the basis, and that's going to give you a big spike in the basis, right? Because you've just taken out the primary players. Okay? So that's kind of an account of fragility. Okay? I mean, people sort of know this story, know about the hedge fund basis trade, and this is just kind of a model of that. All right, let me just show you. Oh, another thing you can do. Here's just, this is for free, basically. Up till now, I have assumed that the hedge funds can borrow essentially at the riskless rate. There's no kind of repo spread. It's very easy to add a repo spread to this market. Assume that basically the dealers have to use some of their balance sheet space to intermediate the repo market. They borrow, call it at the riskless rate, but they turn around and lend at a spread. If that consumes some balance sheet, now you're going to have all these spreads co-moving together. The repo intermediation spread, the basis, and measures of market liquidity under strain will all kind of co-move together. If that's the case, that's going to create one more source of problem that's going to force the hedge funds to unwind. Okay? Let me say two things. On the one hand, something like this is good motivation for something I'm kind of fond of, which is the idea, and I was involved in a G30 report with that Tim Geithner led, with Darrell Duffy and Pat Parkinson, where we were trying to make the case that the Fed should be willing to repo lend to anybody that could bring Treasury collateral. It was about bypassing, essentially, the dealers when their balance sheets were clogged. Okay, so on the one hand, this makes that sound like a good idea, maybe, I mean, barring other considerations. On the other hand, it also makes it clear it's not a panacea, because I got a pretty big problem going even when I assumed the repo market was functioning completely frictionlessly. You know, the fundamental problem is really kind of a wealth shock for the hedge funds. It's not just a liquidity problem. So, of course, giving them liquidity on better terms may be helpful, but it may not be kind of a panacea. All right, so let me just show you some facts. Okay, so this first fact just comes directly from a paper by my colleague Jonathan Wallen with Lena Liu, who's at the Boston Fed. And again, maybe many of you knew this. I didn't, and it was super eye-opening for me. So what they did, they were able to get from confidential Volcker Rule reporting data. They're able to see for the biggest 5 US dealers at the daily level for each trading desk what their risk exposures are. So they just literally report their DVO1, which is sort of how much their portfolio moves for a 1 basis point change in rates. And this is for their aggregated position, derivatives plus cash. Okay? So the top graph is essentially their DVO, the combined DVO1 of these dealers. And the units are such that, like, the biggest number you ever get here is 20 million, and a 20 million DVO1 is like saying it's the same interest rate exposure as if you had 20 billion of 10-year bonds. Okay? Not a whole lot, and that's the biggest it ever gets. And what I really want you to see is around 2020, they were pretty much flat. They were pretty much flat. Okay? So they're not taking interest rate risk. Okay? The bottom thing is saying, well, what are they actually holding in physical bonds? I want to, by the way, make this is already an understatement because it's cash, but it's netting the long cash positions against the short cash positions. So there's already some of the hedging in this, but you're already an order of magnitude or more bigger. This is sort of 250 billion. So of course, it's absolutely the case that when there's a lot of selling of bonds, they're on the other side and they're buying bonds, but they're not getting long interest rate risk. So again, if you're trying to fix their problem, you don't need to take interest rate risk as the Fed. That's really the whole kind of takeaway here. And that's true irrespective of who's doing the selling. If the hedge funds are doing the selling, they're taking both sides from the hedge funds. If it's a foreign central bank doing it, they're taking the bonds, but then they're going out and doing the hedge themselves, so they're still winding up essentially flat. All right, so that's kind of one thing. This is to show you, this is using CFTC data, where you can see the short positions of the hedge funds. So, this is the blue. So here we were in March 2020 when we had the sort of episode, and the hedge funds were short about 500 billion of Treasury futures. One thing I just want to draw your attention to, if you thought this was a problem, it's getting a little bit worse, because now we're sort of order of magnitude $1 trillion. Okay, and just to make the point that this probably is the trade that we're thinking of, I also have their hedge fund net repo borrowing in treasuries, and it pretty much is the mirror image, both visually and actually scale. So it really is as if every unit of short futures is essentially 1 unit of repo, which is what you would get if they were almost 100% repo financed. Okay, so that's the hedge funds. This is trying to show you how the whole system kind of holds together. The blue line is the exact same blue line. As I said, who's the demand on the other side? It's the asset managers. So if you look at the asset managers, their position is pretty much the mirror image. And then if you squint at the red line, which is the dealers are sort of on the right side of the trade. They're kind of doing the same thing as the hedge funds, but much, much smaller scale. Okay, so they're not really, the frontline arbitrageurs normally are the hedge funds, and the dealers are kind of just dipping their toe. And you can do a regression which sort of makes that point, which is if you just look kind of at a $1 change at a weekly level in the asset manager's position, it's going to be met by about 80 cents by hedge funds and about 17 cents by the dealers. Okay, so that's sort of a rough sense of the relative roles they're playing in normal times. Okay, this is the basis. This is just the spread in some sense between the cash and the derivatives. Turns out, some of you will know this. This is actually a little trickier to measure than you might think, because you really have to be smart about cheapest to deliver and a bunch of stuff. When we tried naively to make this series, it was a little harder. I know you know this, right? But it was a little harder. We ended up throwing up our hands, and Anil got Ken Griffin to give us the Citadel series. So I think this is a pretty good series, but it's a little, this is like a case of don't necessarily try to do this at home. But again, the point to make here, the basis is generally positive. It's small in normal times. It's a handful of basis points. It's not attractive, again, unless you really lever it. And then we got this enormous, it was about a 9 standard deviation spike in 2020. Okay, some of you will ask, well, this is weird. What about, I always thought it was the other way around. And it used to be. So an interesting thing, LTCM famously blew itself up with the exact opposite trade. Back in the day, the spreads were the other way around, and it was that the treasury, the physical treasury, was more highly valued, so LTCM was shorting the treasury and long the derivatives. Something really dramatically and persistently changed in a very sharp way. I'm showing you here the swap spread, changed right around the financial crisis. I don't have a great story. Sam Hansen and co-authors have said some of this has to do with the GSEs. Fannie and Freddie used to have big portfolios of mortgages that they would hedge, and that gave them a sort of demand to short futures. Some of it may have to do with regulation, although it's really pretty sharp. I don't have a great story, but it has been persistently, basically post-GFC, it has had this kind of shape. Okay, here's the one little regression that we ran, which is asking, again, the prediction of the model, if you will, is that as Treasury supply increases, futures positions will, the hedge funds futures positions will go with it. Okay, so we have some regressions that are basically, you can look, for example, weekly around Treasury auctions. And if you want to be a little bit careful, you can do this like in a panel, because you have physical treasuries of different maturities, 5, 7, 10, 20, and you have futures. And so even with like auction fixed effects, you can ask the question, is it the case that if the supply of, say, 7 years goes up a lot, that hedge fund positions in the 7 years go up a lot? And the answer seems to be yes. And the magnitude is sort of like 5 cents on the dollar, which is like saying if Treasury supply increased by another 10 trillion, we'd get another 5. I mean, this is an absurd exercise for me to be doing with weekly data, but if you wanted to do the absurd exercise, it would tell you something like another 10 trillion of Treasury debt would give you another 500 million of hedge fund position. I'm not taking that seriously, but it does show that there is some correlation between, that there's something going on where Treasury supply tends to drive this thing. All right, let's look a little bit closer at what happened in March 2020. So again, you get this stress on the hedge funds. I think in this case, it was margin calls. And so again, they're in blue. So you see the blue line going up. So now this time scale is very short. You see the blue line going up by $150 billion in a very, very short period. It's going up because they're covering their short positions, which is like a positive move in their net futures position. So that's going up. Who's taking the other side of it? In the short run, you can see it's the dealers. So that's basically what's happening, is they're fire selling this position and the dealers are having to take it. Okay. In the longer run, what you would expect, right, is the dealers is sort of a lot of stress, the basis is going to spike, that will call forth an adjustment. This was not in our model. So in our model, the asset managers were inelastic, they were just theta. But of course, that theta should depend on how expensive it is for them to use derivatives, right? When the basis spikes, it's getting very expensive to do things with the derivative relative to the cash. Okay, so over a more gradual horizon, the adjustment is done by the asset managers, right? So you get a spike in the basis, it's telling these guys don't do this synthetic thing very expensive, and they gradually adjust. But at the sort of horizon of weeks, it's basically taken up by the dealers, okay? And that's, I think, what the Fed was in effect trying to help with, okay? So now I just want to show you kind of how various measures of stress were moving. Interestingly, and kind of nicely for our story, the first thing to really go is this. This is the Treasury spot future spread. This is the Citadel kind of series. And this is all in units of standard deviation. So basically, this guy goes up by about 9 standard deviations. Okay, very, very big move. And then other stuff starts to go. As I said, repo market should be pretty integrated under stress because the dealers are basically moving balance sheet around. And so there you go. So repo, the GCF tri-party spread, that's sort of the repo intermediation spread. That's also like 9 or 10 standard deviations. Okay, the swap spread, in principle, our model doesn't really explain why this is not done quite as leveraged as a trade, I suspect, because its convergence properties are less good. So I think people are not as overextended in that. So it spikes, but it doesn't spike. It's more like a 3 or 4 standard deviation spike. And then, as we all know, various measures, I mean, Darrell Duffy has like 20 of them. This is just one. But any measure of Treasury market liquidity you're going to want to look at is going to also spike around this time. Okay, and again, this is sort of what you would expect. All right. So this is our idea. And again, I don't think, I think we probably wrote this paper a little wrong in the sense that we started out being very focused on the fragility created by the hedge funds. This policy proposal, I don't think really rests on that. I think it really ultimately just rests on the observation that the dealers tend to be hedged. So if for whatever reason you decide you want to be taking sort of this, load off the dealers, you can do it on a hedged basis. Okay. Yeah, there's really no reason for the Fed to take duration risk. So I think there's going to be all kinds of worries about something like this. I think the first thing that people are going to say, reasonably, entirely reasonably, geez, I mean, you're talking about bailing out the hedge funds. That doesn't feel good. So, yeah. Okay, again, I'm trying to make a much more kind of modest relative statement, which is if you were just about to unroll the unhedged QE to deal with this, that has moral hazard issues too. I think it has worse ones because, in effect, if the market dysfunction correlates with anything at all with the term premium, you're kind of capping, you're putting a Fed put on the term premium more generally. That's a much stronger kind of thing, and then you're taking all that risk out of the market, and you're creating a moral hazard just for people who want to like play carry trades, for example. Okay, so I think this in some sense has less moral hazard than outright buying would have. The other thing you can do a sort of Badgett spirit thing, which is you don't have to completely cap this basis. There's various ways to implement it, but you don't have to completely cap the basis. We saw it went up 9 standard deviations. Suppose your policy is, I'm going to let it go 3, but not further than that. Then you'd be leaving a considerable amount of risk on the table for the hedge funds, but you'd still be maybe preventing the worst market function stuff. So I think you can deal with it. But all right, now I'm going to say some stuff that is not like meant to be serious policy, I guess, given the realities of the world, but I think it's sort of a useful thought exercise. What would be so bad? Suppose you really committed to do this quite aggressively. In fact, let's go even further. Let's take the hedge funds out. Well, let me do it in 2 steps. If you did it pretty aggressively, if they always knew you were going to step in, it's true that make the hedge funds more aggressive would also take all the profits out of the trade. So maybe that's not so bad. Okay, let me go a step further. Suppose you really want the hedge funds out of this. You don't want them to be getting any kind of moral hazard benefit. The Fed could just do this themselves. You could imagine a world where the Fed just says, I'm going to stabilize the basis. Okay, again, I know you guys aren't going to do this, but like, why not? Okay, so think about what I'm sort of saying here, right? The Fed is going to take no credit risk. They're going to take no interest rate risk. All they're going to take is basis risk, which they'll never lose on because they're the Fed and they print money, so they can always hold the trade to convergence. Okay? I think it's very much in the spirit of the Friedman rule. It's saying, look, there's this demand for warehousing, right? There's this demand for warehousing. Who can provide this warehousing service for free, right? No credit risk, no interest rate risk. I'm going to pose this as a little bit of a puzzle. I mean, by the way, the Fed does intervene. It intervenes with like, deviations of the CIP basis with swaps. It's a sort of puzzle, like intellectually you're sort of drawn to like there's something to this. Now, if you don't do anything more, it sort of explains too much. It's going to get you to flatten do you really want to flatten like the equity basis? No way. But the logic kind of puts you here. So again, you're not going to go there, but going part way may not be the worst thing in the world, maybe, okay? There are some design issues. You say this to Fed legal or to other Fed people, they just sort of reflexively don't really like it. You know what this is? Economically, this is just repo. It's just repo. I'm not talking about the legal whatever. It's just repo. What is it? It's a purchase with a forward agreement to sell. The only thing that makes it different than repo is in repo the counterparty is the same to both legs. Here in effect you've got a different counterparty. Okay? But it's the same thing. It has a much smaller footprint economically than unhedged purchases. Matt Levine called this synthetic lender of last resort, which I thought was actually a pretty good thing. What else did I want to say? Yeah. Again, there are going to be concerns about should the Fed be in derivatives, and there are concerns about counterparty. But I think at some basic economic level, we're not proposing something that looks all that different. Another thing to mention is, the other way to do this is the Bank of England way, which is rather than literally forward selling, is when you buy the bonds, you say, I promise, this is market function, I promise I'm going to sell them in a week, in a month, or whatever, right? So why do this as opposed to that? 2 points. One is, they did it and it worked. You've got to have more confidence in when the period of kind of turmoil will end if you're going to make a date commitment. Here you don't need to do it because it's embedded in the fact that you've already done the forward sale. You can roll the futures. You're already duration neutral from the get-go. The other problem is if you have a very kind of pure view that the only way monetary QE works is stock of duration multiplied by weeks or months of duration, then committing to get out soon is good. If you think there's also flow impact of asset purchases, then if you buy a ton today and say, don't worry, I'm going to reverse this next month, you're still going to have an impact on the long rate. Okay, and you're still going to have some of, I think, the blurriness with monetary policy. So I think of this as a sort of more elegant way of kind of committing that it's really pure market function. Okay. Last thing, this is kind of outside of our thing, but given kind of the topic of this conference, when all this sort of talk about the Feds, and I don't want to say this about the ECB because I think there are different issues, but for the conversation around the optimal size of the Fed's balance sheet, there seems to be an idea that we want to get it as small as we can before we bump into problems. And I've never completely understood this. And this is just the same kind of Friedman rule thing, which is I don't see the argument against a really quite ample balance sheet. So you're far away from any trouble. I completely understand the discomfort with the Fed taking a lot of duration risk. Okay, completely understand that. It's in some sense overstepping kind of its role versus the Treasury Department's role. It's creating legitimate interest rate. It's in some sense overriding the Treasury's debt maturity decision. Get that 100%. But I think the right metric for sort of big central bank footprint is units of either credit risk or duration. A purely large in dollar terms balance sheet that holds very short duration stuff. So imagine you had super ample reserves, but it's just because they're holding a lot of 1-year duration stuff. I really have a hard time seeing why that's something you want to be super conservative about. Okay? It's the same idea. There are some things that the Fed can, here it's providing monetary services, in the other case it was providing, warehousing services. But if it can do it better than anybody because it prints money, I don't really see the big deal. So that's the sense in which this maybe kind of connects to some of the other themes. So that's that. Let me stop and we'll do some Q&A. Okay.
Thanks, Jeremy. I'm waiting for hands. As I wait, just a question on, you said it's not so clear to you why the basis switches from negative to positive around the GFC. I mean, could it have anything to do with, after that you talk about the supply of treasuries. I mean, the GFC is exactly the point in time where the US switches from a low public debt to a high public debt regime. Right?
That's got to be right. So if
below
it was
60% to plus 100.
I think if you put that together
within a year, actually.
Yeah, you put that together with the GSE argument, that may go a long way.
Okay.
Yeah.
Good. Then we have Isabel and then Loriana on this side. And I apologize, we have a third question here. We take 3.
Thank you very much for a fascinating speech. I will come back to the point that we already discussed briefly before your speech, which is actually your final point. So why should the central bank care about the size of its balance sheet? Yeah. And so I would argue that the Friedman rule applies only when you really have a frictionless world. So when you do have frictions, then, for example, by providing an infinitely large balance sheet, you're basically crowding out entirely the private market. There will no longer be an interbank market, which, as far as I know, also from supervisors, is actually super important in order to assess the creditworthiness of the banks and so on. So you're losing very useful information. Of course, you could also take the view, and actually for us, it's also one of the principles that we have, that you kind of support the open market economy. So you do not crowd out a private sector activity if it's not necessary. Then there is the Acharya Rajan argument about a large balance sheet also creating this kind of liquidity dependence, which then creates financial stability risks. Then there is the question of fiscal dominance. So is it a problem if or monetary financing, is it a problem if the central bank buys all these government bonds? And there are further arguments, but these are just to give you a few ideas that we've been discussing here when we decided for an operational framework that has the explicit intention to have the balance sheet rather smaller than larger.
So, so we talked about your first argument was new to me a half hour ago. That's the best one I've heard. I mean, I don't know if ultimately you end up, I don't know how scarce you have to get for there to be enough of a kind of, unsecured lending market, but that seems like a totally legit thing. I wouldn't push back on that. The Acharya Rajan thing, I don't know how many of you are familiar, and I don't want to go off on a whole thing. This sort of idea that you get addicted to liquidity, like the sort of strongest version of their argument goes something like this. Banks find themselves with a lot of reserve. It has a weird history dependence to it. Banks find themselves with a lot of reserves. They're like, oh my gosh, what am I going to do with all these reserves? I'm going to write a bunch of credit lines. Then when reserves go down, they're like, I kind of like writing all these credit lines, so they don't bring them back down, and now you've got some kind of a liquidity problem. If there was sort of good empirical evidence for that, I would take it. I'm just not sure how much I believe that. The dominance thing is obviously something we need to be thinking about in the US now. I think I would argue if what you're doing is just buying T-bills, you're not really doing, what would be an enormous fiscal dominance concern is if they decide, I don't like interest rates going up because of inflation worries, so I'm going to do yield curve control. That's like the pure thing. I think just passively buying short duration stuff while you're still controlling the short rate doesn't have that same concern as far as I can see. But it's the argument's very contingent on not getting big in the market for duration.
Okay, then we have Loriana next. So in the middle, if you could answer a mic. And maybe if you could stand up and mention your name or affiliation, whatever you want to say.
Okay, so Loriana Pellizzon from Goethe University and SAFE here in Frankfurt. I want to stretch your argument on the fact that central banks can also consider to use derivatives, so future, that I know is clearly a very delicate topic. And the reason why I want to stretch it a little bit is because, I have a paper also with Davide Tomio here, where we are looking to the basis, negative basis in this case, that during the QE period has been generated here in Europe between the Bund and the future on the Bund and the BTP as well.
Yeah.
And there in that paper, we were also suggesting that, if also by doing QE, you can also consider the use of futures rather than just buying the bonds, because in this way, you are going to reduce this pressure on the bond and, in this case, use the future to close the basis. Do you think that then, indeed, we can stretch your argument and arrive to the point that the central bank should start to think also to include in their tools also the use of derivatives rather than just the bonds?
Yeah, I think I think it must be essentially this. If you say, we are now going to do QE, standard monetary policy QE. When we do standard monetary policy QE, we do pay attention to the relative prices of stuff on the yield curve, right? You sort of try to buy the relatively cheaper stuff. So if you just expanded that a little bit and say, well, right now we're in a configuration where the futures is a cheaper way to execute. Yeah, I think that probably has good normative. There are a bunch of situations where I feel like if the Fed behaved commercially, it actually has the right, it kind of aligns with welfare, which is you're just giving the market the thing it values more. And why not? Yeah, I mean, again, then somebody might say, oh my God, now you're in derivatives, which I agree raises a set of kind of counterparty issues and who's clearing and all of that. And I don't mean to sort of, downplay that, but I think it is also worth recognizing when the economics are very similar. I mean, I think some of the legal objections I've heard have, in the end, been not really legal objections, but like, we haven't historically done this and it feels a little uncomfortable. But then I think it's at least worth pushing to see really where the discomfort's coming from. Yeah. I agree. And again, what we're proposing is effectively economically a form of repo, which is the most comfortable kind of go-to thing. So it's just a little unconventional, right? And it's just like buying futures is really not that different than buying the bond, right?
So could I push this a bit more, because you focus now on treasuries.
Yeah.
But would you go as far as to say that one could apply this to any other type of asset?
No.
That
so this is where I think there is just...
Like we bought corporate bonds.
Yeah, there's a hole in my understanding, which is like, let's start with something I think we're all comfortable with. If the CIP basis blows up, central banks tend to intervene with swap lines, right? And we have some intuition. At the same time, I'm guessing that if the equity futures basis blew up, people would sort of shrug their shoulders, right? So we have some intuition that the former matters more for the real economy than the latter, but I don't really... well, the CIP basis is much closer to being like a cost of synthetic dollar funding, so we think it matters for credit. Here, I think the linchpin of my argument would have been, we don't care about the basis itself, but it's so tightly tied up with the other things that dealers do. It's sort of a co-holdings argument. It's the same guys who absorb that fire sale are the ones who are making markets and treasuries and intermediating repo. Maybe we don't believe the same about convertible bond arbitrage spreads. Right? But I think there's actually just a whole, I mean, I feel like this is like an actually interesting topic and the reason I wanted to push this logic is to just sort of, why do we believe that like some of them sort of make sense and I don't have a great answer. I would certainly be uncomfortable with the idea that the Fed is going to just like smush every basis, but I wouldn't have a great argument as to why I'm uncomfortable.
Good, then I would like the mic to go to this side, third row here. Yes, thank you. If you could mention your name.
Sorry, I will remain seated because I have coffee here and I don't want to spill it. I'm Hinako Kijima from BIS and BOJ. Fascinating read, eye-opening, I would even say. And so if we could go back to figure 4 in your slides. So
can I do
looking
that?
at the, oh, you don't have, oh, sorry.
Should I
so
try
just looking at the hedge funds, treasury, futures positioning and repo borrowing.
Oh, I've lost control of
Okay,
I'm
that's
sorry.
fine. We could all look back in the paper, but so most likely that the basis trades are at its historical peak by looking at those
The size
metrics.
of it, yes.
Yes. Despite this, so in April, so after the announcement of U.S. Tariff announcement and the market turmoil, so the basis positions and the cash future basis remained relatively calm and muted compared to other like swap spreads. So my question is, perhaps, do you have any ideas what would explain the stability compared to what we saw in March 2020? Would it be like something more structural improvement in the intermediation of leveraged basis trades, or?
I don't know. I'm not inclined to take too much comfort, just because it's the nature of all these unwind phenomena is that they're super nonlinear, right? You go, it's stabilizing, and all of a sudden just everything. So maybe we were lucky and we just didn't quite hit that point, There was more action. And this is sort of a subtle question. There was more action apparently in the swap spread this time around, because I think for various reasons people had gotten themselves a little bit more levered in that trade. No, I actually took it the other way. I thought, we dodged a bullet, but there was still some. Yeah, I don't think that. I'm not too comforted by that.
All right, we have many hands here. Let's just take the mic in the same row here in the middle. Yes.
You mean, yeah.
Very interesting and insightful. I'm curious how you think about the push for, easing balance sheet regulation
Yes.
for dealers in the context of this. Because the idea is, if you want to relax the supplementary leverage
Yes.
ratio, do central clearing, that helps dealers to step in bad times. But I guess given your findings and the extent to which this depends on reverse repos, do you think that this would also create more of a buildup of the problem in the first place, so that how much capacity is going to be used up ex ante and how much is there left to be used up afterwards?
This is a really good question, and I came into it with I just sort of hate the leverage ratio. I just hate it, like personal animosity. And so I came in with a pretty strong prior that was kind of to blame for a lot of this. The Fed did the obvious thing by excluding treasuries and reserves from the calculation of the leverage ratio. That didn't do as much as you would have hoped. I think I've come around just by virtue of sort of not having that's helpful, but that's not the whole thing. So, this trade is not, it doesn't have duration risk, but of course it has a bunch of basis risk and a lot of sort of deconvergence risk. So if you think of yourself as a dealer firm trying to step into this, right, especially when the market is super volatile, your risk models are going to kind of, apart from any leverage ratio, steer you away from it. And that's kind of how I started to think about, again, this Friedman rule kind of thinking. The Fed can step into one of these trades and not worry about basis risk because by virtue of printing money, you never get forced out of a trade soon. That's, in some sense, it's the friction that gives the Fed arguably an advantage here. So again, I think there's lots of good reasons to not like the leverage ratio, but again, I don't think that getting rid of it here is magic in any way.
I'm going to take the privilege of the chair to kind of take you a bit out of the paper, since we have you here very rarely. So one question that the paper triggered among the team, and by the way, the team here is this is my favorite conference here because we have the markets experts, the monetary experts, the researchers, and they organize it together, and it's quite unique to have that blend here with the policymakers. So we have a monetary policy wing and a markets, market functioning wing, like most central banks have. And so the question that was triggered by this paper, but I know you have thought about a lot yourself, also when you were at the Fed, like, what do you make today of this separation between market functioning and monetary policy functions in central banks?
Well, I think it's, I think it's not an accident that, for example, the BOE was more effective in handling this than the Fed was. I think the separation is pretty helpful. And I think that alone, even if there were other issues, would have prevented this sort of bleeding in that you had. Like, again, if it's just interesting to read the Fed statements, where it's at first all market function, then it's just language that's kind of a mush of market function. And I think if there was just a clearer separation, you wouldn't have that. So I think I don't know if you have to do it by literally having a separate committee, but there is some virtue in really having people. And I think it just, the other thing that I think the BOE does is it just forces you to, you can't just sort of punt the financial stability stuff in the way that I think the Fed has on occasion. The thing that used to frustrate me is we would have these very good financial stability reports, and then you'd bring them to the FOMC, and it would be, well, got some lights flashing yellow, nothing flashing red, let's set it aside, right? There was sort of a default tendency to want to bin it a little bit, and I think that a different system, a different sort of committee system might be helpful on that dimension.
Good. On that note, I'm unfortunately running out of time here. Jeremy, thank you so much.
Thank you. It's a pleasure. Thank you very much.
I want to alert you to the fact that we have a very interesting session now, of a poster session. It's quite special in the sense that, so we have this what we call European system of central banks. So it's some larger, some smaller. It's more than Euro area. So there are other countries still that are not part of that. And they do research together, and this time around we're showcasing in the back some of their work. Much of that work is between these national central banks and ECB colleagues. So please go take a look, ask questions. And with that, thank you, Jeremy.
Thank you very much.